Hi, I'm Callie Santini with Palm Springs Life, and welcome to Hot Purple Energy's The Desert We Want presents A Tale of Nine Cities, a Market Watch real estate economic forecast. Today we have two incredible speakers joining us to discuss the future of real estate in the Coachella Valley, Mike McDonald with Market Watch LLC, and Walter Neal with Franklin Loan Center. Hi, guys.
Hi. Hi, Dolly.
Before we get started, I'd like to thank our corporate sponsors, Franklin Loan Center, California Desert Association of Realtors, and Palm Springs Association of Realtors. We're going to go ahead and get started, and Mike, we'll start with you.
Thank you, Dolly. Good morning, ladies and gentlemen. Welcome. This is actually the seventh Tale of Nine Cities presentation that we've had. It goes back to 2016. And, well, let me delete myself here. I can't watch myself. Okay. So this has been going on 7 years. It's our year-end summary for 2021 and also our forecast for 2022. I'm going to be presenting information somewhat focused on the internal structure of the real estate market itself in the Valley and make my forecast from that because we have a unique situation there. Walter's going to come in from the other side and talk more about the economic side. And it's kind of interesting, the two forecasts dovetail, all right? A little bit later in the year, we'll get into that. I think you'll find it exciting. So we have a lot of information to cover. So let's get right into it. Tale of Nine Cities. And what I'm going to do here is, I believe in the old phrase in presentations, know before you go. I think the worst thing to do in a presentation is to keep the audience guessing, looking at each slide. Where is he going with this thing and not finding out to the very end? So you don't know kind of how to do it right, you know, how to figure things out. But to tell you up front what the summary is of the presentation and also the forecast, you'll know exactly what the conclusion is. And then we're going to do that right up front. So really in the first 5 minutes, you'll know everything about the presentation. And then we'll lay out the evidence that created these conclusions and forecasts. And then summarize it again at the end. I think that's the best way to go about this. So we're going to give you a summary of last year's housing, okay? First, last year registered 30% plus price gains in almost all cities and sectors in the Valley. It was an unbelievable year, not only in the Coachella Valley, but other areas. But the numbers in the Coachella Valley are probably 30 to 40% greater than the gains in the other areas, okay? This is, for example, Orange County, San Diego County, parts of Riverside County, and even LA County. They all had great years, but not quite as good as the Coachella Valley, and I'll show you that. Sales remain strong and are still 20% above pre-pandemic levels. Now, during the pandemic, unexpectedly, sales surged to record levels, and they've been coming down slowly since that. But even right now, currently, they're still 20% above the pre-pandemic period. So even though they're reduced a little bit from the peak, they're still near record highs, okay? Inventory and months of sales ratios continue at all-time lows. This is a very, very, very important factor, and we're going to focus on that because that's the forecasting factor. We'll explain why it's so important, where the numbers are, and what it ultimately means, okay? Luxury home prices up record 18% in 2021. We developed something for you, which is a complete analysis of the luxury home market, okay? And I'll show you the information that led to this final conclusion of 18%. And this is interesting. Revenue, dollar revenue that you make in commissions and the corporations and companies that you work for and the realtors that you work for generated is up a record amount of $28 million a month. That's revenue. That's not sales. That's not dollar sales. That's 4% of dollar sales. Okay. Okay. We estimate 4%. We'll go to revenue. It could be a different amount, but the important thing is it allows us to compare, if we use that fixed number, the past with the present. Okay. And we'll show you this record level and how it compares to previous years. Okay. There were 1,890 new homes built in 2021. That's the highest number. It's double what it was, almost triple in some cases, what it was 3 or 4 years ago. The outlook for 2022 is the same. We'll explain. We had hoped that it would go higher, but there are factors that are preventing it. We'll get into that. because the hope is that new home market would create the inventory that we're not getting from the resale market. The combination of the resale inventory and the new home inventory would give us enough home supplies to satisfy all the home buyers' needs. We're not going to get that this year. It's going to be a good number, but not what we had hoped for. Real estate industry remains one of the top employers in the Valley. We'll show you the numbers on that. And now into the 2022 forecast. This is our forecast for the year. We expect another year of double-digit price increases. Probably more than a lot of people expect. Now, later in the year, we might have a slight hesitation. We'll get into why. But I think over the whole year, it's still going to be another double-digit gain, okay? Unit sales will probably decline for a number of reasons. One, prices are getting awful high, and Walter's going to be talking about interest rates going up and mortgage rates going up. That's going to also put a little bit damper, but it will not probably, if we get price rises, change the dollar sales. In other words, if you have a 10% drop in sales, unit sales, for example, but you get a 10% rise in home prices, you have no change in dollar sales, which means that your revenue for the year will probably be about the same as it was last year as a forecast. Okay, and this is the most important forecast in my opinion, until MOS ratios, month of sales ratio, that's inventory divided by the sales rate. That's supply and demand. Sales is demand, inventory is supply. So the month of sales ratio is a direct measurement of supply and demand. And it's the overbalance, very little supply, high demand that's been driving home prices higher. But until that, and right now it's at 0.6, until that ratio gets over 2.5, and we got a long ways before we get up to that, low inventory will continue to dominate the housing market over economic factors. And I'll explain that as we get into that slide, okay? New home construction in 2022 will not supply the needed inventory. I've mentioned that before, but I'm reiterating it again here. At some point, higher prices will increase new listings. That plus, I think the receding of COVID as a worrisome factor in many people, that's going to help too. So we'll get into that point. But at some point, higher prices, the number of people can afford these prices fall away. But right now, that doesn't matter. Inventory is so low that you can have fewer home buyers and still have upward forces on home prices, okay? So that is the summary. That's where we're going. Now we'll show you the evidence that led to that, okay? Housing statistics for 2021. This is the median, the Valley's median detached home price. You've seen it in that monthly report we do for the two boards. You should get this if you're a board member. This goes back to 2002, and what is the median value during the bubble years of the first millennium? As we turn the millennium there was the crash, the foreclosure period, the recovery, and in the last couple of years here, so this is a 20-year period, we've been on an upward swing really for 2 years straight now. But last year, we entered the year at $615,000 for the median value of detached homes in the Valley. That's all 10 cities, 9 or 10, whatever you want to call it. It was a year ago, 520,000. That increase is 18.2% increase. And this is a 5% per year annual gain. We're actually been, if you go all the way back 20 years ago, we're above that. We're probably averaging, if you go back all the way to 2002, an annual gain of about 6%. That would come up here at a slightly higher angle and meet up around here, okay? Now let's take a look at the attached home market. The median attached home price in the Valley was up 22.4%. We have not seen attached homes outperform price-wise detached homes. This is the first year we've seen this in a long time. It was flat for a number of years here. It's very seasonal, by the way. But this one, we went from $329,000 a year ago to $402,900 at the end of last year, okay? That's a 22.4% per year gain. Same time period here. So a lot of people, since they can't find inventory of detached homes, are moving into the attached home market because they really want to live in the Valley. There's a tremendous desire to live here. And if people can't find what they're looking for in the detached home market, they're going to look for the attached market. That's shifting the focus a little bit from detached to attached, and we're starting to see that not only price-wise, but also sales-wise. Okay, now let's take a look at each city. Now this, I'm going to explain these tables. This top table is the price of the average size detached homes in each one of these cities. Bermuda Dunes, Rancho Mirage, Palm Springs, Indian Wells, Palm Desert, Indio, Desert Hot Springs, La Quinta, Coachella, and Cathedral City. Okay, these are detached homes, and this is the average size detached home in each one of these cities. Bermuda Dunes, 2,500 square foot home, is the average home size of a detached home in Bermuda Dunes. Rancho Mirage, the average size home is 3,175. Indian Wells is 3,450. The average home. That means there's a lot at 5,000 or 6,000 to bring the average at 3,450. Palm Desert only 22. Indio 2,000. Desert Hot Springs 16. Where's Palm Springs? 2,175. Okay. Now what this is the price per square foot of this average size home. So notice, for example, Palm Springs has the actual highest. By the way, that we rank these not by any of these numbers. We rank them by the percentage yearly change. So the cities are ranked by the 12-month change over the last year. So if you take this average this average price per square foot, multiply it by the square foot, you come up with this price of the average size home. Now these are different way of presenting prices. It's much more accurate than the standard way of statistics using the median price over a sales period of time. That does not really give you a very good representation of home prices in that city. So we've developed a much, I think, more accurate way of doing it. And you're seeing that here. This is the price of a year ago. Notice, for example, the highest price home is Indian Wells, but that's a 3,450 square foot home. We have in Palm Springs, the average size home is almost it's 1,185,000, but that's a 2,175 square foot home. And you see that difference in the price per square foot average. This is the 12 months change. Notice 9 cities have average price gains over 27%. Highest is Bermuda Dunes at 49%, followed by Rancho Mirage, 36% year-over-year change at the end of last year. 36 for Palm Springs, 34 for Indian Wells, all the way down to Cathedral City at 22%. These are the gains off of the all-time lows in 2011. Remember that long-term chart? You saw these depression lows, these foreclosure lows back in 2010 and 11. These are the prices back then. This is the percentage gain. For example, Palm Springs is up 266% off the low. This average home back here in 2,175 square feet sold at the low in 2011 at $323,000. Now it's going for 1.1, almost 1.2 million. So these are all the statistics at all the detached homes in the major cities. These are the attached markets. Notice these are higher percentage gains than detached. We saw that in the index, didn't we? So the attached homes had higher percentage gains than detached, and we're seeing it in individual cities. For example, La Quinta, my goodness, that's one of the major attached home markets is La Quinta, almost 50% gain year over year. That's unbelievable. So we have these statistics for you here. These are truly amazing numbers. I do analysis in some of the other cities in Southern California, and you see pretty good numbers, but nothing like this. Coachella Valley has really participated in this market. Sales are still above last year and pre-pandemic norms. I already mentioned this. This is going back to 2017, 2021. So what's that? 5 years, I guess. Yeah, 1, 2, 3, 4, 5 years. Okay, it's 5 years of time. Now this darker line here is total sales. This is detached, attached, and you can see how attached is maintaining its sales level while detached is coming down, which reinforces what I mentioned, that the interest or focus is shifting a little bit to the attached market. But notice this, we had that big surge at the beginning of the pandemic, got up here to the peak, and we've been slowly coming down. But even now, we're averaging 1,000 units. That's a 12-month average. Over the last 12 months, it takes out the seasonal fluctuation. We're averaging 1,000 units a month, total sales, detached and attached homes. And that at 1,000 is above the pre-pandemic average by 20%. So this shows you there's still the strong demand. Even at these higher prices, demand continues. It's backing a little bit, but it still remains high. Okay, inventory. Now we're getting into the interesting, I don't want to say problem, I want to say factor that is really driving the market. This is the most interesting factor that's creating all the conditions. Inventory. This is total inventory. This includes detached and attached homes in the Coachella Valley, and it's composed of the total inventory of those 10 cities or so. And so notice, for example, and it's seasonal. You can see the seasonal characteristics in it. But the important thing is, if you go back, for example, to 2017, 18, 19, we used to be between 3,000 and 4,000 homes for sale. And right before the pandemic hit, it was about 3,000. And then, boom, we've been slowly coming down. One of the reasons we've been coming down is because sales surged. So they were gobbling up homes at a faster rate than new homes were coming on the market. And that dropped the sales, inventory down. If we ended a year ago in December, we ended 2020 at 1,500, and we ended this year at 607. And I think last month at January, the end of January is 590 something. So it still remains low. This is the issue. If you don't have inventory, you can't sell homes. It's amazing that resales are sales are staying high with this low number. But we'll get into that again a little bit later. But this is the factor is not receding yet as a factor. We'll talk about that. We think it probably will later on this year. But notice the seasonality. We get inventory rising from around September into maybe February or March, and then it comes down. So we've already had the surge in inventory, which is really flat. So we're not going to get a seasonal influence here that's positive. So there's nothing working in our favor yet on this inventory situation. And let me show you the next slide. This is the month of sales ratio. This is the most important factor, okay? The month of sales ratio continues to indicate an extreme seller's market. Now, what is this? Again, it's inventory divided by the sales rate. Normally, in more normal times, it's 4 months. In other words, if the inventory is 1,000 homes and you're selling 250 homes a month, it would take 4 months to liquidate the inventory. So it's a measurement of supply and demand, okay? Anything really over 4 months was a buyer's market. We were in a buyer's market a number of times back here in the 2017-18 period. Seller's market was really below that. Now we're way down here to only 0.6. That's very, very low, okay? And this, just the force of demand over supply is so extreme, and that's what's causing these huge price gains. You have multiple bidders on these homes. And now notice, for example, even if inventory doubled, and we went from a month of sales ratio from 0.6 to 1.2, we're still far below this. In other words, we're so out of balance. It's going to take a lot of inventory. We'd have to get the inventory to go from that 600 number up to 2,500 before we started getting a little bit back into balance. So realize that the economics is not part of this factor. Economics, really, interest rates and the economy drive the demand side, not so much the supply side. It's the demand. How many people can buy, qualify to buy? That's demand. So higher interest rates will affect demand, but it won't affect supply too much. A little bit, but not as much as the demand side. So this is why, until this structural imbalance of supply and demand gets resolved somehow, which we can discuss later, the economic factors will not be the driving factor, because it just drives demand. We already have enough demand. Even if you relax demand by higher interest rates, there's still more demand than supply. So the imbalance is more important at this point than the economics. So now we have other factors. Extreme seller market exists in every valley city. This shows you every city here. The dark color represents the month of sales ratio. Currently, Palm Desert is 0.4 months. Remember, the regional average is 0.6. La Quinta, 0.5. Bermuda Dunes, 0.5. Palm Springs, 0.6. Indio, 0.6. Rancho Mirage, 0.7. These lighter numbers are the year-ago levels. So we see really a seller's market in every market across the spectrum. The higher priced region of Indian Wells always has a slightly higher month of sales ratio, but 1 month is historically, we used to see ratios of 9 months for Indian Wells, 8 months, sometimes 10 months. That was normal. Now 1 month is still extremely low. So we have this situation existing in every city. The effect of all this is a near all-time low in the amount of time to sell a home. Now, what is this chart? These are days over here, 10 days, 20 days, 30 days, 40, and this goes back to December 2016. So it's really 2017 to present. And this shows the average length of, actually median number of days to sell a home in the Coachella Valley. Used to be on, I shouldn't say on average, the median value used to be around 60 to 70 days. And then the pandemic hit. Now we're down to, last year it was 38, now it's 26 days. That's less than 4 weeks. It's hard to get any smaller than that, you think. I mean, my goodness, just set up to show a home and then get the deal done. And but they're going like that, all right? I can't imagine getting much lower here, okay? Driven again by low inventory. Now, the effect, we're starting to see that on multiple bidders. Now, what is this? This shows you each one of the cities again, and it shows you whether the average home is selling at a premium or a discount. We never had premiums before. The last 12 years, we've done the analysis of the real estate market, and we've never seen premiums. We've only seen a premium really in the last year or so. Premiums are where you're selling at more than list. Normally, invariably, you always sell lower than list, and in a few cities, you still are. But for example, Bermuda Dunes is selling on average 1.8% over list price. Now, this is always due, we have an interesting phenomenon, but you always start getting premium prices when there are multiple bidders. You never get it when there's just one bidder. Because why would they pay more than list if there was nobody else who wanted the home? So you always had to negotiate down and sell it below list price to get a sale. But the multiple bidding situation is creating this but for the first time, we're getting this situation where people, even though there might not be multiple bidders, there's fear of multiple bidders. So this carries over even after the point when maybe there are not multiple bidders, but people offer over list because they really want the home and they're afraid of somebody else coming in and taking it away from them. So it's a little bit fear of the boogeyman, you know, when you a little bit, and we're having some of that now, okay? But notice we have these premiums. Now, Indian Wells, again, is a little bit lower, and Rancho Mirage is right at list price on average. So this shows you the current state of the market in the Valley. Now, I want to show you something we developed. We mentioned it in the summary, and we've developed a way to analyze the luxury market. The luxury market, well, the Coachella Valley is unique. It has this wide spectrum of homes, all the way from lower priced homes in certain regions of the valley to exclusive estate homes that wealthy people from all over the world come. So it's a eclectic mix of homes. It's a wonderful place because of that. And there's never been a way to measure actually what this luxury market is because homes are so unique. Bighorn, are prices going up or down? There was no way to really measure if things were going up or down, or are sales doing well, what's inventory. So we had to develop a mathematical way to actually do it. One of the problems is each area is so unique, you needed enough statistical numbers to work with to come up with reliable statistical results to say, is it getting better or worse? Is it going up or down? We did that. And we want to show you what we did here because I think you'll find it very interesting. This is a luxury home price index, okay? Coachella Valley Luxury Home Price Index. A little asterisk here says this is an index made from price averages in the top 15 luxury country clubs and subdivisions, is the best trend indicator for this sector of the market. And we take it all the way back to 2012, okay? So it shows you, for example, and what we're really averaging, we took 15 of the top country clubs and golf clubs and use sales from those, put them together in a very mathematically coordinated way so that it's big enough, we have enough sales so the calculation is reliable enough. You see, one or two sales doesn't tell you anything, but if you have 50 or 70 sales in there and you statistically measure that, the result is reliable, okay? So we did that, for example, and the average price really that we have over here, it represents average of a 4,500 square foot home, luxury home, in these 15 regions, subdivisions, I'm sorry. And for example, going back 2012, the beginning of 2012, the average price, the price of that 4,500 square foot home was 1.4 million. It slowly rose. There was not a lot of activity in the luxury market price wise, but recently, last year, this index was at 2,281,000. We entered the year at 2,697,000. That is, and you can see this tremendous price increase. So the luxury market is participating just like the other sectors of the market. It's up 18.2%. We're going to take a look at all the various indicators in this sector of the market. These are the 15 country clubs we chose: Andalusia and Andreas Hills, Bighorn Golf Club, El Dorado Country Club, Indian Canyons, Movie Colony, Old Las Palmas, Tamara's Country Club, Hideaway, Madison, Reserve, Thunderbird Heights, Toscana, Tradition, and the Vintage, okay? These are the average size home in each one of these country clubs or golf clubs. And look, for example, the Madison has an average home size of 7,200 square feet, 7,250. Now, remember, that's the average. That means there has to be 10,000, 11,000 square foot homes in the Madison. So this is an unbelievable area. And notice, for example, Bighorn, the average home is 5,250. And so we have the average square foot. I think you'll find this interesting. The price at the end of the year, price per square foot in that country club over here, end of the year price. Okay, these, for example, Bighorn, that price of that average 5,250 square foot home was $3,460,000. Madison was down here at $8 million. Price of that average 7,200 square foot home. Price a year ago, and the percentage changed. So for the first time, we have a way to measure the performance of the luxury market. I think you'll find it very interesting because this accounts for 10% of all dollar sales comes from this sector of the market. Even though it's only, what, 15 country clubs, I don't know how many. I think there's, at last count, 150 subdivisions or country clubs out there, plus other areas that are not rated, that are kind of independent areas. So even all dollar sales, including all the entire region, 10% comes from the luxury market. Now let's take a look at sales, okay? This is total sales from those 15 country clubs pre-pandemic. Here was so it has the same pattern as the whole region, flat and then up for the pandemic and down a little bit. And we used to average around, what's that, maybe 26 sales per month, units per month of sales going back 2017. And it jumped up here. We're almost got to 44 on average sales per month. In the luxury market, it's down to 33. So we're still, has the same pattern. We're still above the average pre-pandemic, okay? Now, inventory. This is inventory. Listings of luxury homes have fallen like all markets. This is inventory back to 2017 of those 15 subdivisions. And normally we averaged, let's say between 200 and 250 listed homes, luxury homes for sale. Last year, at the end of the year, dropped to 124. It's only 32 homes. So actually, that is a larger contraction percentage-wise in the luxury market than the other cities and areas and subdivisions of the valley. So in other words, if you have the money and you're a wealthy person, you want to come out and enjoy the region, there's very few homes to pick from at this point in time. Let's see, this is the average selling discount, selling premium discount. Okay, normally luxury homes sell at a larger discount than normal homes. On average, prior to this, the discount was about 6%. And now we're still, even though some of the areas have premiums, very few do. We have over here the country clubs that do have premiums. There's only 4 of the 15: Indian Canyon, Thunderbird Heights, Tamarisk, and Movie Colony. All the others are still selling at slight discounts. This is year ago numbers. The average for all of these is 2.2% discount, but that's much better. It might get to the point where with only 32 listings that people start bidding up for these homes, and we could get to the point where we actually start selling at a premium in the luxury market too. Okay, average selling time is down to 79 days in the luxury market. Here are the average selling times in each one of the subdivisions and year ago numbers. So some of these have very short selling times. The average is 79 days for the average luxury home in the region. Okay. So that's the part on the real estate market. I want to talk briefly on the effect of the housing market on the economic viability and outcome of the region. Okay, how the local housing market helps drive the local economy. People forget about it. They're aware of the importance of the medical industry, retail sales, the entertainment factor, amusement factor, the various conventions we have out here. Those are well-known industries. People forget about the real estate industry. But there's been, since the new home market was suppressed for so long, people forgot that those jobs, new homes, you have to do a lot of employment there to build those. Plus, people build homes, pools. They need landscaping, et cetera, et cetera. So there's a lot of jobs that come from remodeling, pools, and landscaping. And also, 40% of all homes are second homes. So there's construction going on here, and that revenue from other areas of the country comes in, and we benefit from that. So let's take a look at some of this. I'm going to show you. This is courtesy, by the way, of CVEP, Coachella Valley Economic Partnership. And I want to thank Joe and David for the work they did to help us on this over there. They're doing great work, and we intend to help continue to work to see if we can bring some of these numbers more up to date, because home construction was so low, it didn't really pay to follow it. But now it's coming back. We're going to see what these numbers are in more present time. But in the past, for example, this is the employment. Between 2000 and 2010, real estate accounted for approximately 1 out of 8 jobs. These are the various sectors. Notice the biggest employer was retail, trade, then hotels and amusements, agriculture, construction. That's new homes primarily. So we were the 4th largest employer, then health services. And then also, what is not noticed is the financial, insurance, and real estate. The primary component here was the real estate employment sector. You add that to that, and you have really one of the top factors. We have an asterisk here. Dollar resales indicate that income from this sector has doubled over the last 2 years. We pointed that out earlier. This money stays in the region. So the real estate sector, either new homes or the resale part of it, is adding a tremendous amount of stimulus to this economy. And I mentioned too, real estate revenue from resales has doubled over the last 2 years. I want to share the numbers. These are very interesting. What we did is we took total dollar sales from 2002, took 4% of that as an estimate of the revenue coming from the resale market, and we plotted it, okay? And dollar sales, notice, for example, if you go back, this is millions of dollars a month in revenue, real estate revenue that you earn, okay? And it used to be maybe 7 million a month. And it stayed here at maybe 10, jumped up here to 15 here in 2017 as prices started going up. And now it's at 28. $28 million a month revenue. This is doubled. And this is the revenue generated by resales in each one of the cities. La Quinta is the top city. The resale revenues coming from La Quinta is 6.34 million. The lowest is Coachella at not even a million. So we have these numbers here, and we wanted to show these to you and how this should continue. Our forecast is these high revenue numbers, even if sales numbers drop, the dollar increase in the dollar value of homes should keep the revenues at high level. So we expect this to continue. New home construction is rising, but question mark. Okay, now what is this? This is a picture of new home sales in the valley, 1,000, 2,000, 3,000, 4,000, 5,000 units going back to 2000. And notice here we had this huge surge during the beginning of the millennium, and then we fell off with the difficulties in the housing market. We got down to the point where we were only building 500. In 2010, 11, 12, it rose to 800. In 2016, 670. It started being flat, just under 1,000 units for 3 years here. 2019 jumped in 2020 to 1,390. Last year jumped to 1,890. We had hoped that this thing's going to go up, but we did a very detailed analysis. Vic Cooper, my partner, did a very detailed analysis. He knows more about new homes than 10 people combined. He's an amazing man. And he put together these forecasts, new home forecast for 2022 in detail. There are 37 active projects at the beginning of this year. A lot of these are going to be sold out and be phased out, but new plan projects are coming on board, 27 of them. And at the end of the 2022, there should be 36. So the number of projects should not be growing, should actually be one less at the end of 2022 than it was this year. And our forecast of what they can produce, each one of the cities, is 1,893. That's a little disappointment. We wanted to hopefully get new homes, maybe up to 2,500 and eventually 3,000. One of the problems is and it's a problem for everything, is this supply chain. It's taking, I think Vic said it's taking 6 to 9 months to build a new home. It used to take 3 months. They just don't have the work, they don't have the workers to do it, and they don't have the product to do it. And that's a crimp. And other factors are entering it too. So we're not going to get help from this sector in this low inventory problem. But I think the following year, we'll have to rely on Vic to come up with that number. I think we will. So, summary, I'm not going to go over this again, but I'm going to go over the forecast real quick. We expect another year of double-digit price increases. Unit sales may decline, but dollar sales should remain high. In other words, that means your revenue, okay? Until month of sales ratio get over 2.5, low inventory will continue to dominate over economic factors in the direction of home prices. New home construction in 2022 will not supply the needed inventory, and at some point, higher prices will increase new listings and the receding of COVID as they worry. So, ladies and gentlemen, that is Market Watch presentation for me. Okay, and I'd like to bring on now Walter Neal, president of Franklin Loan Center, who's going to show you a completely other angle to this situation, because I've just shown you one side of it, and he's going to show you another very important side. And at the very later in the year, I think these are going to merge. So thank you very much.
Well, Mike, thank you very much. You always do such a tremendous job taking complex data and putting it into graphs and presenting it in ways that we can use it and digest it and pass it on and add value. So terrific job there. For all of you who are watching this Market Watch event, I do miss seeing you all in person, your beautiful faces. It's nice to thrive off that energy in the room, but I'm going to look at my computer screen and this camera and try to keep my energy level up. So let's just jump right into it. I'm going to give you Franklin Loan Center's 2022 forecast and outlook. Some very interesting things for you to be thinking about and pondering on. So let's jump right into this. But before I get into 2022, I'd like to revisit our forecast from 2021. In 2021, our interest rate forecast was expected rates to rise beginning of the year and recover into the fall. And what actually happened last year is rates did rise sharply through March as expected, but recovered a bit earlier than we expected, gaining back most losses by the summer when we were thinking more like the fall. So we were pretty right on there. It actually recovered quicker than we thought. So that was a positive thing, getting rates back in line. Also for housing last year, our forecast was strong demand and tight supply would push home prices up by high single-digit percentage. And actually what happened was there was stronger demand and tighter supply than we thought. But COVID caused supply chain disruptions and labor shortages, which pushed real estate values even higher than our robust forecast. And the reason I use robust is because when we came out with this forecast last year and we were expecting high single digits appreciation in real estate, half the people out there were saying that real estate values were going to decline. So we were on the right end of this. We just didn't realize it was going to be as robust as it was. So that's a positive for all of us. So that's a recap of what we said in 2021, and we're going to show you what we think here in 2022. So there's several dynamics that are going to play into real estate and the market, interest rates, housing, jobs in 2022. And the Fed's going to play the major role in 2022. They're going to be talking about their tapering. Tapering is where they buy less mortgage-backed securities and less mortgage bonds, which they've been doing. They're tapering that. They should be complete of buying those bonds and treasuries by March, which then they're probably going to be looking at doing rate hikes, which is the Fed funds rate hikes, which is currently at 0. So I'll get into that. And then the wild card here, which I'll talk more about also, is their balance sheet runoff. You know, they've got $9 trillion on the Fed's balance sheet of mortgage-backed security and treasury bonds, which they've been buying to put liquidity into our market to help us recover through this COVID pandemic. So it'll be interesting to see with that. So I'll get into that further. So these are all going to impact the equity markets, which is your 401ks and your stocks. It's going to drive interest rates, which is obviously very important for people who are financing their homes. And it's going to impact housing because the more affordable interest rates are, the more affordable housing is. And this will also impact jobs. So I'll get into more of all of that. Some Fed voting members rotate each year. This is important to understand who's in control of voting for our monetary policy. In 2022, the composition will be less accommodative than it was in 2021. There's actually 19 Fed presidencies, but only 12 of them vote. And every year, 4 people wrote in and out of the rotating. So those 4 people voting in 2022 that were not voting in 2021, and the people that are voting in 2022 are definitely more hawkish than dovish. Dovish is meaning let's use the government's balance sheet to do everything we can to drip the economy on, where a hawkish view means let's take out some of the stimulus and let's let the economy run on its own. So fighting inflation is going to be the main focus of all of these Fed presidents. Unfortunately, a negative stock market reaction could cause the Fed to lose their resolve. So it's going to be very interesting to see how they attack inflation. Inflation is the #1 thing that the Fed is focused on getting control of in 2022, and I'll be talking more about that. The Fed should have hiked sooner. They mistakenly thought inflation was transitory. How many times did we hear that on the news? It's transitory. It's going to go away. It's going to go away. Well, they were dead wrong. It did not go away. Now it's a little bit out of control, but they're going to rein it in, and I'll talk about how they're going to do that. And history can help us forecast how the Fed's actions in 2022 will influence the market. So what I want to do is I want to look at history to help show you guys most likely what's going to unravel in 2022. Now, the past is never 100% certainty for the future, but the past does typically rhyme with the future. So let me show you what we're talking about here. So I'm going to go back to 1970 for Fed Chair Arthur Burns. And he was a Fed chair in 1970, and he ignored inflation, a lot like Jerome Powell has, which was rising rapidly. Instead, what Burns thought was, this is transitory. Does that sound familiar? This is going to go away. But it didn't. And what happened was year over year, inflation ballooned. And it ballooned from 7% in 1978 to 14% by the time he left office in 1980. And so that is obviously a huge increase with inflation, which I'll get into why inflation is such a negative thing. But Burns remained steadfast that inflation was transient. Higher inflation caused mortgage rates to rise from 12% to 18%. So let's take a step further here, and let's look what Paul Volcker did. So when Burns left, Paul Volcker had to come in and clean up his mess. And at this point, what Paul Volcker did to fight inflation, to protect against what Burns didn't do, is he hiked the Fed funds rate from 11% to 20% in 2 years. That is a dramatic increase. Everyone's concerned right now. We're at a 0 Fed funds rate. Everyone's concerned about maybe going to 50 basis points or 1. Imagine back then when he went from 11 to 20. That was obviously a very aggressive move. A lot of people were concerned about it. But when they did hike the Fed funds rate, which is the rate that banks borrow, okay, so that's what they borrow their money at. So the higher that cost is, the higher the costs go to the consumers. Inflation did drop from 14% to 5%. So Paul Volcker was successful in curbing inflation, but he had to make drastic measures to do that. And because inflation dropped, mortgage rates sharply declined from 18% to 12%. So that was a much needed relief for anyone who was buying properties. When they saw 12% over 18, they felt like they were really catching a break. But there were consequences for Paul Volcker having to be so aggressive and to overdo what Burns didn't do. And the S&P 500 sharply declined by 30% during that time. So that was obviously painful for people who were invested in the stock market. And not only that, but the tighter monetary policy pushed the U.S. into recession in 1982. So let's look further in history here and see what we can do to help understand what we're going through. You all remember Alan Greenspan spent time in the Fed chair for many years through the 90s, but in the late 1990s, the inflation doubled from 1.75% to 3.5%. And what happened? Higher inflation caused mortgage rates to rise once again from 7% to 8.5%, which obviously home buyers weren't happy with that. Real estate wasn't happy with that. Unlike Burns, though, Greenspan took action in the mid-1990s and hiked the federal funds rate, once again, the overnight rate, which we're at 0 right now, hiked it from 1.75% to 4.75%, which is matching the rise in inflation. So from 4.75% to 6.5% matches the increase in inflation of 1.75. So he learned from what Burns didn't do, so that no one had to come in and do what Paul Volcker had to do after Burns. So he was very smart what Alan Greenspan did here. And inflation responded and dropped from 3.5% to 1%, which is healthy. The Fed's target, by the way, for inflation is 2% as their ideal target. So he got it even below the 1%. What happened as well then? Mortgage rates dropped. Once again, inflation comes down, mortgage rates come down, came down from 8.5% to 5.5%. And that sparked a huge refi boom that basically we've been in an interest rate declining market ever since. But there were consequences once again for what Alan Greenspan did. The S&P 500 once again sharply declined by 30% during this time. And that was during a 6-month period. And tighter monetary policy pushed the U.S. into recession once again. So it's very important to understand the recourses of these actions. So what I'd like to do is tell you what's going on today with Jerome Powell, our current Fed chair, why the history of the Fed chairs is important for you to understand where Jerome Powell is in the decisions he's to make. So 2021, inflation increased from 1.75% to 7%. But Powell thought it was transitory. Are you seeing a pattern here all the way back to Burns? Burns was wrong. Powell was wrong. It is not transitory. But because of that, higher inflation caused mortgage rates to jump from 2.5% to currently 4.25%. So interest rates have made a tremendous move up, and they'll continue to go up until we get inflation under control. So what is the Fed going to do? Well, the Fed is currently tapering their purchases of mortgage bonds and treasuries, which means they're going to be buying less of them, which is going to make a demand come from the outside to be able to buy our debt, okay? And will not hike and reduce purchase at the same time. So they don't want to, they're tapering their purchases. Right now, they're still purchasing up until March. They can't raise the Fed funds rate until they stop their purchases, because if they do both at the same time, they equal out to nothing. So they're tapering to 70 billion, which will be done of them buying mortgage-backed securities in March. And I think in March, most likely you're going to see them hike the Fed funds rate from 0 to anywhere through 1/4 to 1/2. So once they're done tapering in March, they're likely to begin hiking in March or May. Originally, we thought that was going to be May, but the last couple months have shown that most likely we're going to see a hike come in March. And the Fed is also targeting 3 to 4 rate hikes in 2022 and 2 to 3 more rates in 2023. So the Fed's going to be very active over the next couple of years to try to combat inflation and also helping bringing mortgage rates down. Inflation and interest rates can still rise until the Fed acts. So until the Fed stops their tapering, stops 100% of buying mortgage-backed securities and treasuries, and starts to increase the Fed funds rate, inflation and interest rates will continue to rise. If the Fed can tame inflation, mortgage rates will drop, but maybe from higher levels, meaning if they don't act sooner, the rates go from 4.25 to 5. And then once they act and address the Fed funds rate, you'll see rates most likely come back down, because the arch enemy of bonds is inflation. So let's look at a recap here. So it's clear of what's happened inside the Fed and why it's so important to understand this dynamic in 2022. So once again, let's just look at the inflation line here. So you had Alan Burns watch inflation under his watch go from 7 to 14%. Alan Greenspan, 1.75% to 3.5%, doubled. And Jerome Powell, 1.75% to 7%, very, very quickly, basically all within a 9-month period. So what happened after these inflationary times? Look what happened to mortgage rates. They went from 12% to 18%. Because when you have a bond and you get a fixed rate of income, and let's say that income is $10, okay? And you go to the store and next month that $10 only buys you $9 worth of goods, then what happens is you have to increase your rate of return on bonds and mortgages to be able to keep up with the inflationary pressures. And so that's why curbing inflation is going to help interest rates come down, because it protects the income nature of the bonds. And so that's why they went from 12 to 18%, because no one was protecting inflation. It was running out of control. Once again, Greenspan went from 7 and 8.5%, and Jerome Powell 2.5 to 4.25. And the reason why the mortgage rates didn't move as much under Jerome Powell is because the Fed is currently buying mortgage-backed securities and treasuries, and they're giving that stimulus. And that stimulus has helped to keep these rates down, which is why it's so important when the stimulus expires in March, they start to hike the Fed funds rate off that 0% to help curb that inflation, to help bring rates down and keep inflation under control. So let's look what happened to the Fed funds rate. Alan Burns, Fed funds rate went from 11 to 20% back then. We're at 0 today. That is a much different economic market than we are today. Under Greenspan, it went from 4 3/4 to 6.5%. And under Jerome Powell, we think it's going to go from 0 in 2022 to at least 1% in 2022. And once again, we think they're going to hike again in 2023, at least 2 or 3 times. We could see the Fed funds rate as high as 2%, probably by the end of 2023. So let's look and see what the inflation response was under. Well, Alan Burns, once they hiked the Fed funds rate from 11 to 20, look what happened to inflation. It came down from 14% to 5%. So they were successful by increasing the Fed funds rate. Same thing with Alan Greenspan. He increased the Fed funds rate by 2%, and you saw inflation come down by exactly 2%. What should happen here under Jerome Powell? The same thing should happen when we start hiking rates, the federal government. In March, you'll start to see inflation get curbed and eventually stop going up and come back down. Mortgage rates. Why is it so important for the mortgage industry? Well, mortgage rates are affected by when inflation is going up, they're going up, as you can see here. But when inflation starts to come down, they come down. So when the inflation went from 14 to 5%, rates went from 18 down to 12%. Same thing with Greenspan. When inflation went down from 3.5 to 1, rates went down from 8.5 to 5.5. So what should happen here under Jerome Powell should decline, and inflation should decline, just like we've seen for the past 40, 50 years in Fed chairs and beyond that. And so let's look at the consequences. There's always consequences to our actions. And I talked about the consequences of Volcker moving up the Fed funds rate so quick from 11 to 20 that the S&P went down 30% and we followed with a recession. Same thing with Greenspan. He increased the Fed funds rate by 4 3/4, 6.5, 2% to curb inflation. S&P went down 50%. A lot of you remember that in the late 90s, and we followed into a recession. What's going to happen this time around? Well, we see stocks being very, very expensive. We see an economy slowing. So is a recession on the horizon? Based on the past, it looks like it should rhyme, and maybe one will be around the corner. Let me give you some more information on that. Here's a long-term trend of a 2-year note bond, and a 10-year treasury bond. And it goes back to 1976, right here, because that was the first year the 2-year treasury bonds were out for offer for debt financing, all the way to current. And anytime you see red, that means the 2-year money was costing more than the 30-year money. So let me give you an analogy. When you go to a bank and you lock your CD up for 2 years, you get paid less of a rate of return than you do if you lock it up for 30 years. Same thing with a mortgage. If you get an interest rate for 30 years, you're typically getting a higher rate than if it's locked in for 5 years because there's more risk there. That's a healthy yield curve. An unhealthy yield curve is typically happens when the economy is unhealthy or the economy is sick. And so anytime the economy gets sick, there's one thing that's always happened is that the yield curve goes negative. It flops, and the 2-year money is more expensive than the 10-year money. And you can see that on this chart. Every time you saw red, where 2-year was more expensive than 10-year, these gray areas are recession. We went to recession. Red, recession. Red, recession. Red, recession. Red, recession. And we had a little dot of red here, and we followed. And by the way, many people don't know, but 2020 is documented in economics as a recession with 2 consecutive quarters of lower gross GDP. So this has always been 100% guarantee way to see the future of recessions. So I want to break this out a little further for you and show you a 1-year chart so you can see just how dramatic this fall has been. If you go back to April of 2021, you can see the difference between 2-year money and 10-year money was 1.6%. That is healthy. That is normal. You know, I actually think probably healthy, normal, somewhere around 1. 1 to 6 is a little bit high, but 1 in here. And then look what happened. December 2021. This has all happened very, very quickly. We dropped from 1 all the way down to almost basically 0.40. And so it's leveled off here a little bit. So this is something we need to watch. But based on the Fed hiking the Fed funds rate, what that does is that actually brings down the long end. So 30-year fixed mortgages, as they start hiking the Fed funds rate, 30-year fixed mortgages will come down. But as they hike the Fed funds rate, short-term rates like 2 years, like the indexes on your mortgages, like your car loans, like your credit cards, like the prime rates that are attached to HELOCs, those are all going to go up. And so if they start to hike rates, you don't have to be a science to figure this out, and the 2-year money gets more expensive and the 30-year money gets less expensive, what do you think is going to happen on this chart after their first 2 Fed hikes? Most likely it's going to go negative. So it's something we'll continue to watch for you. Some wild cards in 2022. Obviously, everyone knows about COVID. COVID plays a major influence on the monetary policy and supply chains. A major surprise in COVID could change outlook dramatically, meaning if some sort of strand came out and pushed this in reverse and gets really unhealthy out there again, the Fed might need to step in. If they do that, that additional stimulus will just flame inflation. It'll just make it worse. It'll push stock prices up temporarily to a higher number that will come down from. It'll cause mortgage rates to rise even further. It'll make the Fed's job of corralling inflation even more difficult. So I'm hoping that the COVID situation, the worst is behind us, and that's not going to flame anything. But really, another wild card that's very important, a lot of people don't talk about, is the runoff of the Fed's balance sheet. The first step is the Fed to stop purchasing new mortgage bonds and treasuries, and the next step is next step is to hiking of the Fed funds rate. So I talked about both those things. They're going to stop buying and putting money into our market, and then they're going to hike the Fed funds rate. Those two things we know they're going to do. But what are they going to do about the $70 billion in mortgage bonds that they're reinvesting off of their balance sheet? They haven't come out and said exactly what they're going to do with that. Right now, any interest payment that's made on that debt, anything that's paid off on those balance sheets, that money gets reinvested into the treasuries and the mortgage-backed security markets, which is helping to keep rates low. So if and when Fed stops the reinvestment, mortgage rates could move higher than previously thought. So that's something that's a wild card, and we don't know how that's going to play until the Fed shows its hand. But they are talking about winding it down a little bit, but not maybe winding it completely down. So we'll continue to monitor that for you. Talked about the stock market. Everyone obviously is concerned about when they look at their stock portfolios, they'd like to see them green days or at least flat up. No one likes to see them down. But if you look at all the price to earning multiple contractions that everyone looks at when you look at a stock market in the most recent title, look at them. They're all extremely overvalued. Everything other than the net repurchase yield and the net payout yield are not extremely overvalued. So we definitely have a market that is very volatile and could change and could whipsaw quickly if the Fed hikes interest rates, which you know they're going to do. So our forecast is a 10% decline in major indexes. It could be a little less, but it also could be a little bit more. So it's something you definitely wanted to keep your eye on. What is our interest rate forecast? We anticipate mortgage rates to rise along with inflation during the first part of the year towards 4.25. Well, we're already at 4.25. They've already rose, and because we're not to March yet, and we still got to get through February. February's almost done here. We got to get through March. The rates could continue to pop up a little bit more until the Fed acts to curb that inflation. With Fed action, softer stock market, and slowing economic conditions, interest rates should head lower in the second part of the year towards 3%. So our prediction is the rates will rise to 4.25 to 4.5 first half of the year, and then we'll start to decline in the second half of the year, probably later in the second half of the year after they've done the Fed funds rate hikes. And then maybe there's a little bit of pain in the stock market. I think you're going to see a little bit of a slowdown, maybe a recessionary time, which would cause interest rates to come back down. So what's our housing forecast for 2022? Well, housing will remain strong in 22, but not as strong as 2021. Demand may be slightly softer due to a rise in interest rates, but we still think it'll be robust. Supply will increase, but it'll still remain tight. And Mike talked about that. Supply is really low. It could come up a little bit and still be very, very healthy. So we think that will happen. Tight labor, supply chain disruptions, semiconductor shortages will play a role. You can't build a house today without a refrigerator, without the equipment you need to run that house. Same thing with cars. So the semiconductor shortage has been an issue. We also think rates will continue to rise. Rents will continue to rise. Increase will remain about 5%, pushing many people to see the benefit in buying. Rents have been increasing anywhere from 5 to 8% yearly here for the last couple of years. So starting to rent homes is very expensive. That will push some people into looking at home buying. And still, rates are still, if you look historically, levels are still pretty good. So forecast mid to high single digit appreciation, still providing a great wealth creation opportunity. So we still think you're going to see mid to high real estate appreciation in 2022. Once again, turn on the news, read some articles. There's many people out there I think real estate values are going to go down in 2022. We do not. With the tight housing supply, we think that the real estate values will continue to rise in 2022. A couple miscellaneous updates for you that I think are very important for people to understand is Fannie Mae and Freddie Mac have come out in the last month due to that catastrophic event in Florida with the condo collapsing, and they changed their whole condo process and what they will finance. Fannie Mae and Freddie Mac is the #1 lender, that #1 buyer of mortgages that lenders use, and they are no longer buying certain condos or buying those mortgages from certain condos. There's what's called an ineligible list. I know in the desert we got about 10 projects that are on it. We can still lend in those projects, but we have to do it as what's called a non-warrantable condo, which means it doesn't meet Fannie Mae and Freddie Mac's guidelines. Okay, which means the rates can be a little bit higher and the down payments can be a little bit higher, but it can still be done. So reach out to your Franklin Loan Center representation for questions on those projects, who's on it, who's not on it, and we can get you that information. Second thing, I think it's really important for the real estate community to understand, and buyers, that FHFA, the governing body of Fannie Mae and Freddie Mac, have come out in January and said, we don't really want to finance second homes or investment properties anymore, or the high balance loans. And these high balance loans are loans that you get relief for mortgages in high cost areas. So Riverside County is not a high cost area. San Diego is, Orange County is, Los Angeles is. They don't really want to expose the balance sheet, the taxpayer's balance sheet, in doing those higher loan amounts. So they're starting to put in what's called LLPAs, loan level price adjusters. Those price adjusters push up the cost of doing a loan, either in fees or in rate or in both. So right now, today, I told you rates around 4.25%. If you're buying a primary residence, by the way, those rates were like 3.5% 90 days ago, 3.25%. Okay, it's moved very, very quickly. Right now, on a second home, rates with Fannie Mae and Freddie Mac are 4.75% to 5.25%. So there's a dramatic difference in fees and in rate on second homes. And as Mike talked about in his presentation, 40% of the desert is second homes. So it's very important that these second home buyers are getting an education from the real estate community before they talk to lenders, so they're prepared that the rates might be a little bit higher than what they're used to seeing financing a primary residence. So that's very important information to get out. Like I said, please talk to your Franklin Loan Center representation for that. Another thing you can reach out to Franklin Loan Center for is for marketing support. We have some proprietary products that really give you great data. A lot of the data you're getting here, similar to that. It takes a bunch of complex things, puts it down and on pen to paper for you, and allows you to use it to use in newsletters, talking to your buyers and your sellers, talking to your friends. We have a same home report that actually looks at every county in Southern California and every city, and looks at the 3 different square footage of 3 different homes in all of those cities and counties, and tells you what the price per square foot is for those homes. So it allows you to show people, hey, there's still extreme value to buy homes in the Coachella Valley compared to San Diego, LA. It brings in Temecula, brings in Redlands, Riverside. It's a great report. We can get it to you electronically, but you have to ask for it. Second thing we do, a proprietary report, is an inventory report. We're doing inventory reports because that is the #1 thing, and that has been a big part of this presentation, especially Mike's. Inventory has been tight. That's what's allowed us to have home values come up so much because the demand is so much higher than the supply. We're doing monthly inventory reports for every county in Southern California and breaking out the cities. If you would like those as well, please reach out to your Franklin Loan Center representation and they will get those to you. So I hope this was very helpful for you to understand the dynamics of the Fed, and the current situation we're in is not new. We've been in this situation previously, and it's most likely going to unfold like the last situations did with the Fed. So once again, thank you all for joining Market Watch. We hope this was helpful for you. I want to wish you a healthy and joyful rest of your 2022. Thanks.
Thank you, Walter. We're going to bring Mike back and do a couple of questions from our viewers. Can you go to the next slide?
I don't have a next slide.
Oh, you don't have a next slide. Okay, that's cool. Keep it there. So the first question we have is for you, Walter. Will second home interest rates recover and improve in the future?
You know, that's an interesting question. So that's out for debate right now. So because of the changes, Fannie and Freddie not wanting to finance second homes and high balance loans, they really just want to help people buy homes as a primary residence. the private market, that market needs to come in and fill that void. And so I think what's going to happen is you're going to see Wall Street come in, open up different avenues of financing that allow second home buyers to get better pricing than what Fannie Mae and Freddie Mac will offer, but not as good as it was originally under Fannie and Freddie. So I think the free market will come in. I don't expect that to happen until probably April or May, because they have to build out these investment vehicles, price them, and get them on the street. So I do think relief is down the road, but right now it is. We have to sell what the rates are. It's just like the stock market. You can't go back and buy, or crypto, Bitcoin at $100 when it's at 42,000. It is what it is.
Thank you, Walter. The
You're
next
welcome.
question is for you, Mike. What are the metrics and methods being used to estimate the current housing unit shortage in the Coachella Valley?
Basically, inventory, all right, which is a count of how many homes are being listed, and also month of sales ratio, which compares the inventory against the sales rate. We have to understand something, because there's a little bit more behind the scenes going on than just inventory. Remember, inventory is a snapshot look at how many homes are for sale at any moment in time. For example, let's say the inventory at the end of previous month was 200, the end of this month is 200. It seems like nothing has happened, but you could have 100,000 homes sold in that period, because it does not calculate or factor in the number of new listings that came on during that month that were then sold off. So it's really the inventory is being added to and subtracted from on a daily basis. So that is the full picture, okay? So once you do that, you look at the inventory at the beginning of a period of time, how many homes were sold and how many new homes came on the market, plus the number of listings that were canceled or expired. That all combination shows you the change. But basically, it's the number of homes listed divided by the sales rate, the month of sales ratio. That's the most important metric that we have.
Thanks, Mike. Walter, this one's for you. How many buyers are cash compared to financing?
We've been tracking that here at Franklin now for 20 years, and historically it's anywhere from 60 to 75% cash. If I had to give a number on it, I would probably say closer to 70%. The higher end is higher cash, like 75. The lower end, meaning prices under $1 million, is more like 65 to 60. So between 65 and 70% of all transactions in the Coachella Valley are cash. Unfortunately, because we like to lend money, but we're happy people are cash.
Wow. How does that compare to other markets, Walter?
Other markets are considerably less. You look at some of the areas in the beach cities, Orange County, San Diego, LA, they're historically at 30% cash. So we do have a lot of retirees, second home people coming to the desert. They've been trained their whole life to not have debt, and they figure if they can't buy the second home without having debt, they shouldn't buy it. So a lot of the buyers out here, second homes, do pay cash. Primary residences, if that's only 60%, if that was 90% of our market, cash would definitely be less.
Wow. Mike, this question's for you. If prices rise double digit due to low inventory, but interest rates rise, will prices be at risk when inventory begins to finally grow?
Oh, that's an interesting question. Because you can get a certain dynamic in the marketplace that drives prices beyond really what the economy really should allows, et cetera. In other words, because of low inventory, you could actually have prices getting higher than is normal, than you would expect. So that could happen. At some point, we could get to the point where once inventory starts coming up, and there'd be so fewer buyers at that high level, plus with higher interest rates, that the dynamic would change. It would become a buyer's market rather quickly, and then you could have some of this price give back. So yes, but that's not an issue right now. We don't have to worry about that now, but it could become one later in the year or as we go into 2023. We'll have to monitor that, but that's a good question.
Thanks, Mike. Walter, this one's for you. With interest rates on the rise and many homeowners having record equity in their homes, how is this affecting refinances and, more importantly, cash out refinances?
Well, that's definitely a question we're getting from a lot of our past clients and new clients that want to pull money out. Do they pull it out through a HELOC, home equity line of credit, because they have such a good interest rate on their first mortgage, their first trust deeds? A lot of people have rates in the 2s and high 2s and low 3s. That's a decision that they're going to have to sit down with their mortgage lender and find out what they can do on a new trustee, because the rate's going to be higher. What we're finding is a lot of people are reaching out to their banks, the bank, Wells Fargo, B of A, Chase, those types of big retail banks. And a lot of people aren't wanting to take HELOCs out because a home equity line of credit is based on prime. Prime is currently 3.25%. If they've raised Fed funds rate in March by 50 basis points, then those home equity lines of credit go up 50 basis points to 3.75. If they raise the Fed funds rate to 1.5 over the next 2 years, now you're looking at having a prime rate at 4.75. So anyone who takes money out and it's adjustable, the rate keeps going up, they're not going to sleep well with that. So a lot of people are considering just taking out a higher rate and getting it fixed now, if they say 4% or 4.25, so they don't have to worry about their rates going to the high 4s, mid 5s, high 6s as pricing comes up. So it's something that people need to look at both ways. We are advising a lot of our clients today to not pay any points on loans, keep their fees low, don't buy the rate down, because we firmly believe, as you saw in my forecast, that we think there's slowing economics coming. We think the Fed's going to get ahead of the inflation, and we see rates coming back down late in the year or next year. So if someone takes a loan out now and they don't pay a lot for it, when they refinance a year from now, they're not so connected or married to that loan. Because if you pay $10,000 for a loan, or you pay zero, 1 year from now and you get a better rate, you're not so worried about stepping away from that mortgage. So we're advising clients to keep their fees low, take the higher rates, and maybe refinance, sort of a two-step process next year in 2023 when we have a slowing economy.
Thanks, Walter. Appreciate that. So to your point, Walter, you did talk about the stock market going down possibly 10 to 30%. So I have a question for you, Mike. How will that affect, or what will be the impact of that on the luxury real estate market?
It depends on how much it declines. Investors in that category, a 10% market is really a decline, is really just a correction officially. It's got to be 20% to be considered a bear market or a significant decline. So if we get to a 20% decline, what happens is that it's very important in the sentiment or the expectations of investors, especially of people who have a lot of money, because the stock market's a leading economic indicator. It forecasts what the economy is going to be doing. And if you have a significant decline like that, a lot of people get worried that maybe the next year or two is not the best time to invest, and they pull back. So it really depends on the size of the market decline. But we've got an interesting, remember the inventory of that luxury market was, what was it, 32 or 36 units, down from a normal 200. So you could actually have fewer buyers, and it's not going to hurt the market much. But if we had more inventory, if that inventory came back, then I think you'd see some kind of an effect. So it depends.
But is it going to affect the prices in the luxury market, Mike?
No. It shouldn't affect prices unless inventory rose. But see, inventory would have to go back up to maybe 50, 60, 70 units again. It's right down at 30. And the number of buyers would have to contract a lot. So I don't see that as a major impact at this point.
Well, one aspect, Mike, is if people see 10 to 15% less value in their stock portfolios, some people might be willing to have multiple homes, especially second homes, which the desert has a lot of. They might be willing to part with them, especially at these high prices they can sell them for. So you could see some listings or supply come to market if people are looking to cash out. And so that could be where the rise of the listings come from, is people getting a little uneasy about what their stock portfolios look like. Especially
in the second home market, which is really the high-end market right there. You're right. I mean, how much gain if you're suddenly their home you bought for $200,000 is worth $1 million, there's a huge gain there, and people start getting nervous and they can take a profit. In other words, the housing market, besides being where we live, is also an investment market. We have to look at that from that point of view too.
Yeah, and not getting into a political conversation either way, but there's a political landscape where it looks like maybe income taxes are going up on certain things, on 1031s, maybe staying, maybe going. So there's a lot of unknown certainties as well in that market. So some people that also might push them to want to bring market properties to market.
That's a very good point. Well, yes.
Well, thank you, gentlemen. It's been a very informative market watch and Tale of 9 Cities. We learned a lot, and I want to thank you so much for these presentations and all the information and data that you provided. I'd also like to thank our corporate sponsors of Market Watch, Franklin Loan Center, California Desert Association of Realtors, and Palm Springs Association of Realtors. This has also been a presentation of The Desert We Want. So we thank Hot Purple Energy for their support of that webinar series. We have our next Market Watch coming up on April 27th, so we look forward to seeing you all there. In the meantime, thank you guys so much. Thanks everyone for watching, and we'll see you all next time.
God bless.
Thank you, Tolly.